Look, I'm always trying to look for ways to talk about something fresh that is happening this week, but also that emphasizes some of the views that we have in the markets. And if you read the news, and in fact, on the Wall Street page, actually, the front page of the Wall Street Journal today, and I'll read, it says, indexes fall as Fed officials cool talk of easing. And I also read all sorts of things and a Wall Street Journal and anything I can get my hands on. But ultimately, it always comes down to doing your own analysis. And by watching uh, the entire interview and also the speech of the Fed chair Jerome Powell, here's a quote that stood out to me that I think it's very important. And he was referring to this, addressing the developments of the last 2 months in terms of data. He said, this recent data does not, however, materially change the overall picture, which continues to be one of solid growth and strong but rebalancing labor market. And I highlighted this section. And inflation moving down toward 2% on a sometimes bumpy path. So, in other words, he didn't really change his views regarding the new data that came in. In markets, it's very important as you gather new data, the facts can change. And let me present to you the reasons why I believe the facts have changed when it comes to inflation. Let's go to the next chart. And so here you're looking at commodities, and it's one of the most important metrics when you're trying to understand where inflation is headed. And in this chart, you're basically looking at equal weighted index of different commodities. And you can see the first wave of commodity prices surge back in 2021, and that was caused by many reasons. That was the first inflationary wave we've had in a very long time, and potentially caused by the fiscal and monetary stimulus. And then we had this invasion of Russia in Ukraine that also caused a panic, in which also drove commodity prices even higher at that peak level that we saw back in March. And now we're starting to see some commodities actually making new highs, which is causing the overall index, as you can see in this chart, potentially experiencing a second wave of inflation. And so for Jerome Powell saying that inflation is going back to 2%, I do think this is a very important metric to be watching for. Let's go to some other ones. Here is another one, oil. So if we break down with oil, energy is one of the most important components of CPI. And I understand that the Fed and other policymakers like to pay attention to core numbers of inflation, but that doesn't change the picture of the consumer, in which has suffered for many years now with the fact that the cost of gasoline and oil overall has been to levels that we haven't seen in many decades. And so now you're seeing here, despite the fact that in the last few months, investors have been incredibly bearish in oil, we're seeing oil actually breaking out. This is a really important development as well, because it is in line with what's happening geopolitically, what's happening with Iran and Israel, especially, and the recent problems that we've actually been hearing about, but also the fact that we know that that production has been incredibly constrained globally, not just in the U.S., and the push towards the green revolution causing one of the biggest movements we've seen of capital flows into energy, which I think that that's going to spread towards the metals and mining industry at some point as well. There's a reason why Warren Buffett owns energy companies, and I think that that's just the beginning of a movement. Nonetheless, this is highly inflationary. Let's go to the next chart as well. And one of the things you can see about, well, where can we see oil trading one day? Well, I like to look at different types of roadmaps. You can never know what's a price target for something, but in the macro world, you're always looking for things that usually lead an index. And one of the things you can look at is equity performance of oil companies that have been very resilient. In fact, they are actually above the levels that we saw during that Russian invasion period. Remember the first wave of inflation, which peaked during the invasion of Russia in Ukraine? Well, the energy stock prices are already at those levels. If we see the blue line, in this case, WTI oil prices go into those reaching that same price that it was back in June of 2022, it would imply an appreciation of about 50% in oil prices, in which I think it's highly probable, actually. Let's go to the next chart. And so another way to see this is inflation relative to agricultural commodities. Agricultural commodities have a large impact in food prices. I don't think I really need to emphasize this, but certainly we've seen the link between the red line and the white line, which is the red line is agricultural commodity prices, and that's calculated by DPA. Somebody sent me an email asking to describe what am I using as the red line. And please just look at the chart. There's, I usually label these things very descriptive way. So look at the chart. It's right there, DBA ETF. If you want to know what DBA ETF is, Google DBA ETF. And this is not an advertising for Google, but you can figure this out quickly. And what you can find here is that there's a 3-month lead on the data versus CPI, and which gives me a strong conviction that CPI is likely to be bottoming here very soon. And the red line, which is the agricultural commodity prices, as shown in the chart, is up about 21% already on a year-over-year basis. If you look at the actual chart, not the year-over-year change of the price, which is what you're looking at, it's actually at record levels right now. I shouldn't say record because it has been higher in the past, but I should say that it's actually at least at a 2-decade highs currently. And so those are other important metrics that if I was the chair of the Federal Reserve, I would certainly be looking at those numbers very closely. Let's go to the next chart. And so if you looked at the global freight cost as well, which is another one that I like to kind of point out, this second wave idea, where does the waves come from? Well, the waves come from studying back other inflationary eras, the 70s, the 1910s, or the 1940s, and understanding how those inflationary periods actually work through waves. And that's a mathematical reasons behind that, but also psychological reasons behind that. And now we're seeing this potential upward movement in world container index cost, in which I think will have also highly inflationary implications, along with what's happening with the escalation of some of the 2 wars happening actually in the world today. So let's go to the next chart. And let's talk about one that is perhaps a little more technical that not a lot of people look at outside of the macro community, which is called the money velocity. Usually people like to say that the reason why we're in the disinflationary period is because money velocity has been collapsing. Well, that has not been the case in the last 2 to 3 years. In fact, we're seeing a major turn in money velocity recently, in which I think it's signaling a bottom for money velocity and potentially the beginning of an upward trend. We don't know yet if that's the beginning of an upward trend. Obviously, it's one of those that we're going to have to watch and see. But if you ask my opinion, and if you ask what the pillars of inflation could be causing, is that this white line is poised to be on an upward trajectory for the next decade. And so this is an important one that will also have a very strong impact on inflation. If I was the Fed chair, I would be looking at this chart as well. Let's go to the next chart. So if you look at the Fed funds rate expectations, which supposedly was seen as hawkish, are still expecting almost three cuts on the Fed funds rate for right now. And so despite the fact that we've seen the cuts actually decreasing, the number of cuts decreasing from, I believe it was 5 or 6 at its peak, now back to 3, it still is supposedly a Fed that has turned from overly hawkish to now supposedly more dovish. So let's go to the next chart. So I actually beg to ask this a very important fundamental question. Why has the Fed turned dovish? Well, there's so many reasons. Now, some people like to say the political reasons behind it. Let's not get political here, although I think there is a lot to do with that. Let's go to the next chart. This is the main reason, perhaps, why the Fed has been forced to also move, is because we're facing a trifecta of macro imbalances. And so here you're looking at a chart that shows the rise of the cost to service the debt, which is basically looking at, it's looking at the interest payments relative to GDP, which has been surging recently. And the other side of it is how much has the Fed ownership of the U.S. Treasuries outstanding has been changing over the years, and we're seeing a decline. And this chart, to me, is completely unsustainable. Given the imbalances we have in the world today, the one institution that is responsible for all this is the Fed. And so they are likely to see that red line at some point increasing. But let's go to the next chart here. And we're seeing on the back of the one of the most restrictive monetary policies in history, at least how it has been labeled as by the media and even by the Fed, the U.S. monetary base has just increased by about $53 billion in the last month, or in the last report of this index. And also, it's been up about $600 billion since the beginning of the year of 2023, or February 2023 to be specific. So what do you think would happen if we see a recession with this metric? And you may think, well, this is just a US phenomenon. No, it's not. Let's go to the next chart. In the next chart, you can see the Bank of Japan assets increase on a weekly basis and this is looking at in Japanese yen terms. It is, we've seen a spike in the data recently, which was about $80 billion worth. So now we're back to US dollars, $80 billion worth of an increase on 1 week in their balance sheet assets. And you can see here, there are so many reasons behind other increases in the past. One of them was when they decided to increase the cap of the 10-year yield. The other one was during the COVID recession in 2012 and 2013 was regarding what they called the DOJ introduced a qualitative and quantitative easing policy at that time. And then we've had the European debt crisis back in 2010 and 2011. And then the debt bust as well caused the Bank of Japan, or the BOJ, increase the number of its assets. And so let's go to the next chart. And another one, just to point out quickly that I've been showing this in the past, is the PBOC. China has also been increasing the size of the balance sheet, which is of a lot of importance as well. Let's go to the next one. So one of, I think, most structural issues happening in markets in the global economy is this chart, is the chart of the divergence between gold and treasuries. Gold is making new highs and treasuries making almost new lows. Not exactly a new lows yet, but if you ask me, we're probably headed towards that. And so what is really going on? I believe central banks are starting to show their cards and starting to accumulate gold in a large way. But more importantly, let's go to the next slide. Why are treasuries falling? It's a very important question. Let's go to the next one, because I give, if we're taking a test and a multiple choice test, and you have to pick one of them, which one would you pick? I know what you're probably going to say, Quinta. You would probably circle the whole thing. But no, the answer is in the following slides. But here is, I just posed, if you study economics, they usually talk about different types of risks, which one of them is kind of stupid, that they say rising interest rates, obviously, because the price of the bond is linked to the interest rate level. So I don't really understand that. But the demand falling and the inflation risk, the credit risk, and the supply rise, those are, to me, the main ones if I would pose here. Let's examine each one of them. Let's go to the next chart. So inflation. So here you're looking at the 10-year yield rising, but inflation expectation, this is what the market thinks inflation expectation or inflation will be 10 years from now, is at about 2.3%. So is the white line increasing because inflation is reaccelerating? No, that's the answer right there. It's right there in your chart right here. Inflation is reaccelerating, in fact, but we're not seeing that really translate into higher 10-year yields. If that was the case, the blue line would be rising in tandem with the white line, and we're seeing a big divergence between the two as of late. And so I think that we're yet to see the downward pressure coming from inflation. That's my point. There's more of a downward pressure to come, especially if inflation continues to stay higher for longer, which is our view here. Let's go to the next chart. What is the second one? Is default risk. So you can look at CDS for the U.S. for the credit default spreads for for the U.S. And you can see here that that's the blue line. Also, it has a link back in 2021 and 2022. Both of them are increasing together, which probably makes sense. And now recently we're seeing a divergence between the two. So the U.S. nominal rates have been increasing, but the default risk is actually been falling. So that doesn't really answer a question why 10-year yields have been rising. Let's go to the next chart. Now you're looking at foreign central banks. That's the demand ask question, because foreign central banks are a very large buyer of U.S. Treasuries and a very large a part of the driver of the demand side of those instruments. And you can see here that all the talk that people usually say that central banks are selling Treasuries, not true. The Treasury holdings by foreign central banks is actually at record levels right now. So what's going on? Let's go to the next chart. So the demand is not really the reason. Supply is the reason. Supply is the one rising. If you go back to the chart real quick, just so we save a number here. So we have a number there. How much do foreign central banks own of Treasury holdings? It's about $8 trillion. All right, keep that number in mind. Now let's jump 2 charts or 2 slides. There we go. And now we're looking at the total amount of U.S. Treasuries outstanding, which has increased by $8 trillion since June 2020. I'm not kidding. The entire amount that the foreign holders hold currently is actually exactly the size of how much has increased since June of 2020 of Treasuries outstanding. So if we go to the next chart, this is the most important development happening in the macro world, in the macro community, I would say, is the fact that foreign central banks are transitioning towards gold. And the white line is showing now that the foreign holdings relative to how much Treasuries are outstanding. So that is one of the most important metrics to be watching for, because we're seeing a flood of issuances and central banks are just not buying Treasuries. And I'm sorry for repeating this chart for 3 straight presentations, but I do want to emphasize that I think this is one of the most important things going on right now. And so we're seeing the bars, the blue bars, which is really gold relative to global international reserves, increasing. And when I said that global central banks are starting to show their cards of accumulating gold, that is certainly the case. And we're yet to see the traditional portfolios actually follow through. And what Kevin was referring to, of that those flows coming back to the mining industry. Remember, the blue bars here are central banks buying gold. Central banks don't buy miners. Therefore, we're not seeing those flows coming into the miners. If the main buyer of gold recently has been central banks, we're not seeing yet the general investor buying into the story of precious metals. But I do think that ultimately spreads towards other things like silver and like the miners. And so that's why that asymmetry to me sounds very opportunistic. Let's go to the next chart. So this is probably the most important chart of this whole presentation. Now, if you look at the ratio of gold to Treasuries, we can call this a cup and handle. For those that are not fan of the technical term or not fan of technicals at all, you can just see that we're actually above the levels we were back in the peak of the bottom of the global financial crisis there, in which this ratio actually fell for about a decade there, as you can see, and now it's started to move up, and now it's starting to break out, and basically I think it's going to be chasing the levels that we saw in the prior highs, which was in 1970 or late 1970s and early 1980s, in which was somewhere close to 6 in this ratio. So there is a 5-fold potential increase for this ratio, in which I think is highly likely. That's just my opinion. Let's go to the next chart. Ratio, I love looking at ratios, and this one, it just blows my mind. I love this chart. It's just looking at NASDAQ relative to commodities. This is another way to see how this market is really a tale of 2 stories. It's how financial assets are so expensive, especially the long duration portions of the market. And you can claim US technology companies are one of the main drivers of that, but also how hard assets, especially commodities, are so cheap today. And this chart highlights this very well. And it highlights the potential for a rotation out of one very expensive side of the market into one that has been for long neglected. And I think that we are in the process of experiencing that. We're experiencing the inflows in commodities, not the outflows in NASDAQ. But I do think that ultimately, in order for money to come into the commodity space, we're probably going to have to see some outflows from the NASDAQ side as well. And so that's why we're firm believers of this rotation theory. And you can do another chart of this, looking at the foreign holders allocation in US equities, in which you're going to see that it is a very similar chart. The foreign holders already have a very large percentage of their assets in US equities. And so where is the money going to come from? Even if we see a large dilution of the monetary system, I think that that's also going to be highly, highly beneficial, especially for the things that are very cheap, and those are commodities. And when you see something like gold is starting to move the way it has been moving, I think we are at the very beginning of a secular move for gold, and which makes me very excited about other things. Let's go to the next chart. And now, if I could look at a chart all day long, if I had to look at a chart all day long, it would probably be this one. That's silver breaking out recently from a quarterly candle, in which you can claim that this is probably the biggest cup and handle ever formed in history, and which supposedly suggests that we're probably going to see new high prices for silver. And so when we think about buying silver mines and buying projects, we always consider, where would this project be if silver prices are at triple or at $50 an ounce or triple digits, perhaps? Is there a possibility of seeing that? I think so. Why is that? Well, production, we know for a fact that production has been falling. And if you accumulate both or combine Mexico and Peru as a production, which was one of the largest, it is one of the largest silver producers countries in the world today, you're going to see that their production combined is down about 25% from peak levels at the same place as it was 14 years ago. So it is not just a demand story. It certainly is a supply story as well. And we know for a fact as well of how much how many new discoveries outside of one of them that I can't talk about it. We have seen a very difficult number of discoveries, a very small amount of discoveries of silver over the last decade as well, which usually is in line with the constrained supply story for the metal over time. I think this might be my last chart, but it might have one more. Let's go to the next one. Okay, this is another one, very important one, just to finalize my point and hopefully hopefully transition to Quentin in a good way here, because this one is basically talking about how, yes, we're seeing the second wave of inflation likely in a lot of different metrics. I posed the example of oil, and then we looked at commodities equal weighted. We looked at agricultural commodities. We looked at global freight cost. All sorts of things are pointing to the direction that potentially inflation is reaccelerating. But there's another thing that's potentially reaccelerating, which is fundamentals of the gold and silver miners. And now that is something that is really off the radar. That industry, or this industry, is probably the most hated industry I know. And so to see the improvement of fundamentals with prices that in some the miners, such as Newmont, not to pick on Newmont, but that is down close to 60 to 70% from their peak levels. And there are plenty others that are in a similar position with fundamentals is starting to improve. This to me sounds like an opportunity and not something you should be scared away. And so I also think that second way of also interpreting this data is the potential for an M&A cycle, which we certainly have started to see recently, pretty much in line with this second wave of free cash flow happening across most of the miners. Nonetheless, I think this is a big opportunity for us investors in the space, but also investors in the exploration stocks, because most of the miners that are starting to make money are also in need for increasing and improving the quality of their own reserves. So not only central banks have to improve the quality of their international reserves, the miners also need to improve their own reserves and therefore are likely to be big buyers of explorers in order to chase that expansion of the quality of their assets, which I think it's the main reason why we're seeing the gold miners actually underperform drastically gold prices, while we're seeing, for instance, copper mines or copper projects actually outperform copper prices. And so, anyways, this is to me a very positive outlook for this industry, which we've been presenting this idea for some time now. And I'm very glad to be in the position we are of having built all these connections and these assets that we own, because I think we're onto something very special. And I think the train has already left the station. And it's shocking, but also very opportunistic to see the valuation of the miners is still as depressed as they are.